Welcome to College Smart Radio, helping you bring into focus the true cost of college and how to tackle the runaway cost of financing a college education. College Smart Radio is hosted by Beatrice Schultz, a certified financial planner and founder of Westface College Planning. Now, here's your host for College Smart Radio, Beatrice Schultz.
Welcome to College Smart Radio. The rising cost of tuition combined with decreased earnings is a big reason why people are concerned about student loans, and it should be. The federal loan programs were developed with an important mission: to ensure students could afford a college education regardless of the cost. While these programs have successfully enabled many students to achieve their goals for higher education, the unintended consequences of the policies are largely responsible for the huge student loan crisis and rising cost of tuition. On today's College Smart Radio program, we're going to discuss a private sector solution to this huge problem, which uses a community-based lending model in which private sector alumni invest in a loan fund for students and recent graduates. Hi, I'm Beatrice Schultz. Welcome to our weekly show, College Smart Radio, where we help you tackle the runaway costs of a college education. Our show is all about bringing up-to-date and practical advice to parents who are dealing with the cost of a college education for their kids. With some traditional private schools costing over $60,000 a year, a UC costing $35,000, and a California State University running $25,000 per year, parents need more help than ever. We bring you that help by sharing ways to pay less, tapping into financial aid, and prioritizing your source of funds to make sure you get through the most expensive years of your life. Based on my own education and experience, I share my insights with you week in and week out. I hold a Bachelor of Science degree in Chemical Engineering and a Master's degree in International Business. I'm a certified financial planner and the owner of the San Carlos-based college planning business, Westface College Planning. I host workshops and webinars on college planning and consult with parents on a daily basis. In addition to my insights, I bring in experts in many areas of the college process, from educators, counselors, financial professionals, admission officers, parents, and even students. You'll learn firsthand the ins and outs of how to pay for college and survive financially. In addition to our show, you can find lots of powerful information at our website, collegesmartradio.com. We have many articles that I've authored with up-to-date information on navigating the waters of paying for the runaway cost of college. We have a monthly e-newsletter full of content about college planning. We also have posted a glossary of key terms used in the world of college planning, terms like EFC, total cost of attendance, FAFSA, and so forth. And we have a link to our free community parent workshops and webinars that I host to teach parents about how to pay for college and how the financial aid system really works. So let's get into today's show. The government perpetuates tuition inflation by allowing students to borrow up to the total cost of attending college. Without a cap on tuition, universities have no incentive to keep costs down and avoid expensive capital projects like state-of-the-art fitness facilities to attract the best students. And in the same way universities have no incentive to keep tuitions low, they are not held accountable for producing successful graduates. The price of a degree should be connected to the outcomes that degree produces, but schools are not at risk of losing money if students don't get well-paying jobs, and unfortunately, that risk falls on the government and the taxpayer. My guest on today's College Smart Radio show is Daniel Macklin. Dan is the co-founder and VP of Alumni Relationships at SoFi. The founders of SoFi have been investigating the challenges facing current and future student borrowers and have a unique perspective to share with us today. SoFi was founded to offer an innovative approach to connect students and alumni through a dedicated lending pool in an original social community approach where students, alumni, and schools all benefit. Dan Macklin holds a BA of Business Economics from University of Durham in England. He also holds an MS Management degree from Stanford Graduate School of Business, where he's a Sloan Fellow. Hi, Dan. Welcome to College Smart Radio.
Hi, Beatrice. Pleasure to be here.
Thanks so much for joining us on the show today. Let's start by sharing a little bit about SoFi, why you started it, and kind of what your goals are with it.
Sure. Well, as you mentioned there, I was at Stanford Business School, and with some classmates, I started SoFi. And why we started it was we were at Stanford and we were looking around and seeing our classmates and our friends having to pay what we thought was a pretty high price for loans to get into the school, or rather to pay for their school. And for graduate school, the primary rates are, as you probably know, 6.8% and 7.9% for the direct loan and for the plus loan. And we thought that seemed pretty expensive. given the low interest rate environment. And we dug a little bit deeper and realized that there's actually not many options out there for people. Post kind of 2008 credit crisis, many of the private institutions who were providing loans have now exited the market, and now the government is providing 93% of the loans. So really what that means is there's not much choice out there, and we sought to expand that choice for people and offer a new way to borrow some money.
And just give me a feeling for how long ago did you start SoFi?
So we started just around 2 years ago.
Okay.
So we graduated in the around May 2010, and then we put the company together. May 2011, and then we put the company together after that. And we created a pilot program at Stanford. So as you mentioned at the beginning, the structure is we take money in the form of investment from alumni from that school, and then we lend that money back out to students and recent graduates in the form of loans or refinancing loans. And in doing so, we're connecting communities that already exist and facilitating financing within a community. So we started at Stanford. We did a $2 million pilot program that was very successful. We had 40 alumni investing in that, and we lent to 100 students. And then off the back of that, we grew in 2012 to the point where we expanded to 78 schools, and we lent around $90 million. That's around 1,500 borrowers that we have now.
Okay, and so the way that you set up these loan funds, are they each college specific? So alumni of Stanford University, for example, would put together this loan fund that would be available for Stanford students and Stanford graduates or recent graduates who want to refinance?
Yeah, exactly correct, Beatrice. So we have essentially 78 of these different funds. There's a Stanford fund, there's a Harvard fund, there's an MIT fund, et cetera, et cetera. And if I'm a MIT alum, I could invest in that MIT fund, knowing that my money would end up going to either a current student at MIT or somebody who's just graduated from MIT.
Okay, and what kind of rates are you offering, and is there a range of rate that would be available?
Sure. So our primary, we have two main loans at the moment. One is for people in school, and one is for the refinancing loan, as I mentioned, people who've already graduated. So our refinancing loan is around 5.99%. And our refinancing loan, our in-school loan, our rate's up to around 6.49%. So there aren't any fees on those loans in comparison to government loans. So we're really competing with the direct loan and the plus loan, the 6.8% fixed rate and 7.9% fixed rate loans.
Absolutely. And so is this a traditional pay back the loan in 10-year type loan after graduation? And do you offer deferral so the students who are current students don't have to start paying back the principal until after graduation? Yeah.
So we have a choice of repayment periods, 5, 10, or 15 years. So it's up to the choice of the individual taking that loan as to which loan they choose. And we do have deferral. So if you're in school, you don't have to be paying principal back on that loan while you're in school. You can defer that until you graduate.
Okay, but does it follow the same model as a Stanford unsubsidized loan where interest would accrue but nothing needs to be paid back until 6 months after graduation? Do you use the same model?
Yes, correct. Yes.
Okay, so how would a student find out about this, apply, and is there enough loans available for all the students that are applying so far?
Sure. So we're in 78 schools, as I mentioned. You can go on our website, SoFi.com, and see those schools. We are not doing a lot of advertising or marketing, but what we're finding is that many of our existing customers are telling their own friends and classmates about us. So good word of mouth is spreading around, and we're getting a lot of demand coming in every week. So we're getting around $10 million worth of applications each week. To answer your question, do we have enough money to fund all those loans? The answer is no, not yet. So we obviously have to match up the investors with the borrowers ultimately. We have some wiggle room. We can smooth out the peaks and troughs, but ultimately those two sides of the coin have to match. And for some schools we have more money and we can lend more money. Other schools we need to raise more invested money so that we can get back to lending there.
And from the investor's perspective, are they just an owner, have an equity or a piece of the loan, and therefore, if any of the loans defaulted, everyone would take a hit in the loan loss? Is that how it works, or what are the default? What's just kind of from an investor perspective? Also, I can understand the motivation because that interest rate's nice in a low interest rate, in the low interest rate environments that we have today. I'm just wondering, how do you manage to attract the investors as far as talking about default risk that they might run into?
Sure. So a couple of points here. It is it's a private placement, so I'm getting into some technical financial language here, but it's limited to accredited investors. So these are relatively high net worth individuals. So we aren't able to talk about the specifics of the investment product itself, but suffice to say that it is dependent. The return is dependent to a degree on the repayment rate of the borrowers within that pool. So if more people default on their loans, then that would negatively impact the return. We hope, and at the moment we have a zero default rate, and we hope to keep it that way for as long as we can, because a couple of things. One, we're mainly concentrating on schools with historically fairly low default rates, and we're trying increasingly to assist that, to reduce that even further by doing a number of things. And one of them is using the community I mentioned earlier. So if you do get into some financial difficulty, or rather ahead of being in that difficulty, if you're moving into that situation, you can reach out to us, ask for assistance, and we can then work with you and work with your alumni community that is invested in you to see if we can help you. And that may make some tangible difference to somebody who maybe has lost a job and is looking for a new job.
Well, I think that's really powerful, the social community. And absolutely, we talk about the fact that alumni or personal connections are a great way to line up your next job or to keep yourself connected. So I like the way you're using that social community in your model also.
Thank you. Yeah, it's a big part of it. The loans in themselves, I think, stand up for themselves, and they are good loans. They are respectable loans in the market and very good value for people. But on top of that, we think we offer something else that the other loan providers can't provide.
Well, I think for students who may be able to qualify, and absolutely there's many students that I see coming through my office who are looking at some of these colleges that can be quite expensive, but that they think the degrees are going to be worth it. They'd love to hook up with some of these preferred loans, and I think it's a really great service. I'm going to take a break right now. You're with us on College Smart Radio, where my guest today is Dan Macklin, the co-founder and VP of Alumni Affairs at SoFi. We'll be right back with Dan Macklin on College Smart Radio.
For more information on today's topic, visit collegesmartradio.com or call area code 650-587-1559. College Smart Radio continues in moments on AM 1220 KDOW. Contact Beatrice Schultz at collegesmartradio.com or call area code 650-587-1559. Now, back to College Smart Radio with your host, Beatrice Schultz, on AM 1220 KDOW.
Welcome back to College Smart Radio, where we help you tackle the runaway costs of college. I'm Beatrice Schultz, talking with my guest, Dan Macklin of SoFi. By raising funds from successful alumni in colleges around the country, SoFi is lowering the rate that students pay on their loans, creating high-yielding investments for the alumni, and boosting the odds that those alumni will help students find jobs also, is one of the things they say on their website. We all know that college is expensive and will most likely be some of the most costly years for a family. Understanding how to navigate the college process and save everywhere you can is a smart thing to know. To help families be on this radio show, I host community workshops live and via webinar several times a month that explain the costs of various colleges, how the financial aid system works, and things to consider to prepare yourself for this tremendous expense. You can find my workshop schedule and register at collegesmartradio.com. Dan, we were just talking about SoFi's program and the loan program, and when we were during the break, we talked a little bit about all the colleges. You mentioned 78 colleges, but I thought for our audience, can you give me a list of perhaps the most popular colleges in California that some students who are listening might think, oh, yeah, I'm a graduate from there. I should be thinking about this program.
Sure, we have a few. So in addition to Stanford, where we started, we're at all the UC schools, so UC Berkeley, UCLA, UC San Diego, and then in addition to that, we're at Santa Clara and USC as well. That's one of our biggest universities by volume of loans.
Well, those are all colleges that, definitely thinking about the UCs, and actually USC and Santa Clara and Stanford are all popular colleges for a lot of the students and families that I'm working with in the Bay Area. Most of them are trying to apply to at least one UC. So if a family if I've got someone listening on the show who's a graduate of one of these colleges, and they're wondering if there could be an opportunity to refinance their loans, how would the process work for them to find out if they can work through SoFi?
Sure. So our refinancing loan is probably our most popular loan. So we're able to consolidate all of the loans that you may have, and someone may have 4 or 5 or 6 different loans out there. So we can package that into one loan at a lower rate, at a 5.99 rate, and then you only have one payment to make each month. And our borrowers tell us that's much easier than having to remember 5 or 6 different repayments each and every month. So the way you do that would be just to go onto our website, www.sofi.com, click onto your school and start to make an application there. We do have wait lists for most schools at the moment because there's high demand, but we go through those wait lists on a first-come, first-served basis. So the sooner you get your application in, the sooner we can get to you, and the sooner we can consolidate your loans at a better rate.
No, I think that's a great program. And for existing students, and so just wanted to check on that refinancing. It's going to be based on the student's credit, if they have any, I assume, the rates, and based on what their job, or if they're working. Would this be available for students who don't have a job yet, or is this something better to do once you do have a job and you have some income to pay back those loans?
So for now, the borrower is required to have a job, and to have a job that pays sufficiently well to pay off the loans. So that is a requirement at the moment. We have some other general credit type requirements that most other lenders would ask for as well.
Okay, and then for the students that might be current students, because you said there may be loans available also for current students, or for current students that are in the program, would their parents' credit have to come into account? Would it have to be co-signed, or how would it work for a current student as far as qualifying for the loan?
It doesn't have to be co-signed, but we have that option there should the student need it, or should the student require it. So I should say that for in-school loans, we lend through the financial aid offices of the universities. So we check with the university that this is a real person with a real need, and then we process the money through the school just to make it clean and efficient.
Okay, so if it's happening through the financial aid departments in the colleges, is it typically that these students are taking on loans over and above the traditional Stafford loans through you, or would be a replacement of?
It could be either. So some people may still be taking a 6.8% loan along with our loan, but ordinarily we are a replacement for those loans. So the 7.9% plus loan, instead of taking that, you may take a SoFi loan. There are still loans out there like Perkins. If you qualify for that, you should still take that because that's cheaper. So you still may have 2 or 3 different loans, but we'd like to be one of those.
Well, sure. The Stafford subsidized loan for our audience is right now still at 3.4%, or was last year, and some people still have some outstanding Stafford loans, and also the Perkins loans that are at 5% are going to be lower. But those are definitely need-based loans, and I think I heard you say that, Dan. So, do you consider for current students that you do want them they need to qualify for your loans?
Yeah, the school has to tell us that they have a need for loans. So if your school has given you scholarships of, full scholarships this year, then we won't be able to lend you money. Only what the school tells us is a borrowing requirement. So every school has their own different way of doing this, but they make it clear to us what is a reasonable borrowing requirement for each and every student, and then we lend to an amount within that amount. So the last thing we want to do is be over-lending to people. So we work closely with the schools to make sure that the amounts lent are responsible and they are necessary.
Sure, and the reason I asked the question, I may not have been clear, Dan, is what happens, what we see with a lot of the colleges is that they estimate that for their student, their expected family contribution, for example, if they were going to go to USC, may be that the family can afford $40,000 a year. It costs $55,000, and the college thinks they need $15,000, and they can perhaps get $10,000 in scholarships and they need another $5,000, but the family may need some to meet some of that expected family contribution of $40,000. That's kind of what the college is expecting the family to contribute. Do you only come in with that $15,000 of need or $5,000 extra of need, or would you also work like a Stafford loan, which is you could take a Stafford loan at $5,500 even if your family had no need? Obviously, you can't borrow more than the scholarships. Does that make sense?
It does. We do work with the schools, but there is always some flexibility with the schools. So if a person is in a situation where they don't think that the stated need that the college says is correct, we can work with them, with the school, to try to come up with a number that's slightly more appropriate. So we do this. In many instances, of course, for a student, they've probably never done this before. They wouldn't really know how to do it. So if that is the case, they should work with us, and we can work with the school to try to correct that.
Okay. Let's talk a little bit about customer service. You mentioned it briefly, but I know it's a nightmare for many students who are trying to manage many loans and paying back different rates, and some of them different loan rates and different types of loans. So how does SoFi work from a customer service perspective to make that easier for their lenders?
Sure. So many of our staff have taken loans themselves in the past, and we understand the traditional pain of the borrowing process. So we've tried to come up with a better solution there. And really we want to try to provide exemplary customer support. And we believe that begins right from the beginning with the loan application, but then it continues through the life of the loan. So it's not that we just want to get people in the door. We actually want to give them a good experience as they repay their loans, as they just inquire as to what their statement balance is, how they pay their loans. So our overall approach is to be very proactive and to give good service from really the beginning of the application until the final repayment is made several years later.
Okay, and one of the things I liked is that you said that none of these loans come with fees. Are there penalties are they set up to be paid on a monthly basis, standard monthly basis? If you miss the payment, you pay a late fee. Is that like a traditional loan?
Yeah. I mean, they're payable on a monthly basis, and there are some reasonable late fees applied. But again, we try and avoid those wherever possible by working closely and proactively with our borrowers. And I think that may be a major difference between us and other loan providers out there.
Well, be careful, because you're going to get a lot more phone calls or a lot more signing up for that wait list after listening. And I already have a couple of families in mind right now that I'm going to be recommending that they contact you guys, or that they go online to SoFi.com. Let's talk a little bit about your community, or you talked a little bit about how Alumni, I guess, an entrepreneurial program that you have, or can you share a little bit about the community relationship that SoFi is trying to build between the alumni and current students or new graduates?
Sure. So we want the community to be more than just the funding source. So if you look at it kind of very clinically, at the moment, the money that people are borrowing is coming from alumni. So in that sense, there's a relationship, but it's purely a financial one. What we are laying on top of that is more of a community feel. And you raised the entrepreneur program there. So that is an example of where this community can really mean something. And what the program is a SoFi borrower can apply to SoFi and say, I have an idea for a new business. I want to be an entrepreneur, but I got this student loan sitting over me. Can you give me 6 months forbearance on my loan so I don't have to pay this for 6 months to give me the opportunity to pursue this entrepreneurship idea that I have? And what we then do is do a bit of diligence on that, and then connect that person to one of our investors who maybe is an experienced businessman or businesswoman in that area, and actually can add some real expertise and some real advice to that student or to that recent graduate. So in doing so, I think we're really showing the power of the SoFi community in bringing investors and borrowers together in ways where both of them can get something out of it beyond the pure financial metrics of the relationship.
Well, Dan, I think that's also a wonderful program, and one that's going to be really interesting for a lot of our listeners. We've come to the end of the show, but thanks so much for joining us. To learn more about SoFi, you can check out their website at SoFi.com, and there's also a link to SoFi on our website, collegesmartradio.com. Dan, thanks for joining us today.
Beatrice, thanks. It's been a pleasure.
Thank you. Well, that wraps up another weekly show of College Smart Radio. We hope you picked up some new information today that helps you figure out ways to manage the runaway costs of college. You can hear us each week here on KDOW 1220 AM, Saturdays at 3 p.m. We promise to bring you up-to-date information from the front lines of helping parents deal with the most expensive years of their lives. For a link to a podcast of this show and our prior weekly shows, go to our website, collegesmartradio.com. In addition to the podcast, you'll also find a schedule of our upcoming shows. Plan to join us at one of our upcoming Westface College Planning workshops. You can reserve your seat at a workshop either live or via webinar from the show's website, collegesmartradio.com. This is Beatrice Schultz. Thanks for tuning in to College Smart Radio. We look forward to sharing more helpful information with you next week.
You've been listening to College Smart Radio with certified financial planner Beatrice Schultz. If you have questions on today's topic, log on to collegesmartradio.com or call area code 650-587-1559. That's 650-587-1559. Join us next week at this time for another edition of College Smart Radio on AM 1220 KDOW.